Hello, I'm Steve Bennett, the CEO of the Charter Hall Direct business. Today I'll be providing a short video where I'll run through the property valuation process so you can better understand how our assets are valued at Charter Hall. I'll be discussing asset-specific details that influence valuations, as well as external market factors. I'll also provide an explanation on the methodology of the three main valuation techniques our assets undergo during our independent valuation cycles. So the first thing I'm going to touch on is some of the individual asset factors which flow through into a valuation and which an independent valuer or purchaser will take into account when they're determining how much an asset is worth. It's important to understand that when valuing an asset, there are individual attributes of that individual property which will have either a positive or negative impact on its valuation. It's a cliche in real estate for a reason, but what's the location like? The underlying lease agreement. What's the rent in that lease? What are the annual fixed reviews and how long does that lease go for? All important considerations. What sector is it in? So for example, industrial logistics may have a different cap rate, discount rate, and even in that sector, the Sydney market will have a different rate to the Melbourne market. Does it meet the ESG credentials, particularly environmental ratings that many investors and tenants want these days? So if you have high energy ratings, solar panels for example, these are positive attributes that people like to see. And finally, how well is the asset maintained? At Charter Hall, we're an institutional manager, meaning we maintain our assets in excellent condition, making sure they meet the requirements of our key tenant customers. But it isn't just individual attributes. There are things that occur in the market that have a big impact on how an asset's valued. So what are the market rents? So not just what you've locked into the lease, but what's happening in the external market for Sydney office rents, for example. If they're going up, they will tend to have a positive impact on valuation. Conversely, if they're going the other way. What are tenant incentives doing? So in the market, valuers make an assessment. Whenever your tenant leaves, what will you need to do to attract a new tenant? Outgoings, so the type of expenses and the quantum that are incurred at a property. How do they compare to benchmark data released by the PCA, Property Council of Australia, as well as other sources? Capitalisation rates and comparable rates per metre are another factor that the valuation fraternity take into account, as well as downtime and occupancy rates that they assume when doing long-term cash flow forecasts. So I've just given you some examples, not an exhaustive list, of property-specific and market data which flow through and impact valuations. But what are the valuation techniques that are used? The three main valuation techniques that are used by valuers in Australia are the capitalisation rate approach, the discounted cash flow approach, or DCF, or the comparable sales approach. A valuation will usually include all three, and the valuer will use that information to make an educated assessment based on their skills, expertise and training to land at a final valuation number. So how does the capitalisation rate approach work? Well, they will take the market income that the property achieves and divide it by a capitalisation rate which the valuer believes is an adequate return demanded by the market. In this case on the screen, you can see that if the net operating income is $5 million, divide it by a 5% cap rate, throws out a property valuation of $100 million. In this example, if your operating income or market income was to go up, it will generate a higher valuation. If the capitalisation rate was to go up, so investors demand a higher return for a given amount of risk, the valuation actually declines. So if cap rates went to 6%, the 100 million comes off. If cap rates reduce from 5% to 4%, the valuation actually goes up. Another common valuation technique is the discounted cash flow. In this valuation methodology, long-term forecasts are made for cash flows, typically out to 10 years, and in year 11, an assessment of what the asset would be worth or could realise at that point in time. These cash flows are then, as the name suggests, discounted back to today's dollars to calculate a valuation. As you can see, please don't get into each line by line you can see on the screen. It's purely to show you how many different variables in terms of revenue and expenses go into this particular calculation methodology. The final valuation approach I'll cover off is comparable sales. And as the name suggests, the valuer will look at other transactions for similar assets that have transacted and what pricing and key metrics were achieved. They'll look at things like what rate per metre on an office building, what is the land value, perhaps if it's an industrial property, and how do they compare to the asset that they've been asked to value. This is something that they track on an ongoing basis, and the data, whilst looking in the past, is still just one of the factors that, with the other two valuation techniques I've already mentioned, feeds through into how they generate the valuation. So to wrap up today's video on valuations, I'll just run through the Charter Hall approach. We believe in frequent valuations by using independent valuation firms. We only use tier 1, that's top rated valuers, and we also believe in valuer rotation. When you put all these together, we believe it creates the highest level of transparency and governance for our funds, and importantly, for the fund investors. I'd like to thank you for taking the time to watch today's video. Should you have any further questions, please do reach out to the team whose contact details are up there on the screen. Thank you.